China, Greece, US interest rates, and falling emerging market currencies. 4 issues which have been the focus of financial markets' attention at various times this year. My aim over the next 30 minutes is to take a brief look at these developments, starting with the fears of a slowdown in China, of which our own assessment is that the events and fears and concerns are much less pessimistic than the prevailing consensus. I will then discuss the question of whether the Eurozone crisis is firmly behind us, before turning to the US economy and the outlook for interest rates. After briefly addressing the issue of whether the latest turmoil in emerging markets is the third leg of the global financial crisis, I will discuss some of the economic issues and implications of these topics for global agricultural commodity markets. But let's start with China. As part of its rapid economic development, China has become a key source of demand for commodities, in particular industrial commodities such as oil and copper. And as such, sentiment towards the Chinese economy and the outlook for economic growth is a factor which has been driving price changes. But to what extent is China important for agricultural commodities? As shown by this chart, as China's share of world consumption and world imports of selected agricultural commodities, from an import demand perspective, while China accounts for a large share of world consumption, from an import demand perspective, its relative importance is mixed. Taking the green bars, where there is a general large share of China consumption in world consumption of agricultural products, it's quite dominant. But when you compare it to the yellow bars, which is China's share of world imports, you can see that for a number of commodities, particularly rice, wheat, and corn, its share is relatively small compared to that of the likes of soybeans, palm oil, and cotton. And so as China seeks to maintain a relatively high share of self-sufficiency in the likes of corn and wheat, the resulting impact of changes in economic growth are likely to be quite small for such commodities. Indeed, in the case of corn and wheat, domestic policies in China are likely to be more important for world markets. And therefore, in terms of thinking about China's economic growth, the changes that occur and its impact on agricultural commodities is likely to be quite varied amongst different commodities. But what is happening in China? 3 developments have hit investor confidence hard this year. First has been sharp falls in equity prices. The second is a run of weak economic data, particularly relating to the manufacturing sector. And third is the messy exchange rate reform of China's exchange rate regime. But in all 3 cases, we think these fears are overdone. And let's look at each in turn. So first, this chart puts the slump in China's equity market into a longer-term perspective. The surge in prices that started a year ago were driven by speculative behaviour rather than any improvement in underlying economic fundamentals. Although a combination of weak economic data and policy inaction in China may have triggered large falls in equity market prices, the bigger picture is that we have witnessed an inevitable implosion of a short-lived speculative equity market bubble. What's more, the debacle in China's equity market tells us next to nothing about what is going on in the real economy. In fact, the impact of the equity crash on the real economy, including China's demand for commodities, is likely to be relatively limited. Now, why is that, you may ask? Well, only a small and relatively wealthy proportion of Chinese households actually own equities. And even they are still sitting on relatively large gains compared to last year. Furthermore, the stock market didn't provide any noticeable increase in consumption on the way up, and therefore there's no reason to expect it to be a drag on the way down. It's also worth noting that in recent weeks, equity prices have stabilised. But if the stock market gyrations tell us very little about what is going on in the real economy, then why have commodity prices or commodity markets reacted as they have? Well, in part, the financialization of commodities means that prices are increasingly driven by the ebb and flow of investor sentiment and positioning, rather than by real demand. The impact of concerns of China's economy on commodities can be seen through the unusually close correlation between Chinese equity prices and the oil price, as shown in this chart. A similar relationship can be found between Chinese equities and the price of copper. So while fears about the health of the Chinese economy have weighed on investor sentiment, it is worth noting that China's oil imports so far this year, in volume terms, have risen 9% year on year, which hardly suggests that there has been a collapse in demand. That said, sentiment has not been helped by some weak economic data. A widely followed activity indicator, the monthly Purchasing Managers Index, which is based on a survey of business activity, hasn't been particularly strong in recent times. And for those who are unfamiliar with the PMI, a reading which is above 50 indicates an expansion of activity, and the higher the number, the greater the increase in output, while a reading below 50 indicates a contraction in output, and again, the lower the number, the greater the decline. Focusing first on China's manufacturing PMI, which is the yellow line in this chart, it has fallen to the lowest levels since the global financial crisis. But as the chart shows, the manufacturing index is still well above where it was in 2009. And it's only a little below the subsequent troughs that have occurred, and from which it has subsequently rebounded. And there are good reasons to think that it will rebound again, particularly as a result of additional stimulus that has been provided by the Chinese authorities. In addition, there's plenty of more scope for the authorities to prime the economy if necessary. Other key indicators have been more encouraging, including hard data on industrial output, signs of a recovery in the property market, and faster credit growth. Finally, it's worth noting too that this chart includes the services PMI, which is the green line. This series is less timely and perhaps a little less reliable than the manufacturing PMI, but it has held up relatively well and suggests that not all is doom and gloom for the Chinese economy. The third key development for China over the summer was the so-called devaluation of the renminbi, which many still fear is the first step towards a much larger devaluation. While the move by the People's Bank of China had the effect of weakening the currency against the dollar, we don't think this amounted to a serious attempt to boost the competitive advantage of Chinese exporters via a weaker currency. Rather, the reform can be seen as another small step towards liberalising China's exchange rate regime and allowing the market to play a bigger role in setting the value of the domestic currency. Furthermore, if China really had wanted to boost exports, it could have simply devalued the currency by 10% or 15%. Now, we do think that the concerns about China's economy are overdone, there's no doubt that the Chinese economy has slowed down sharply, as this chart on China's GDP shows. First, it's right not to take the official data too seriously. As the green line indicates, there has been a suspiciously smooth deceleration in official GDP growth to about 7% in the first half of this year. However, our own China activity proxy, the yellow line here on this chart, suggests that growth has actually been a lot weaker, perhaps as low as 4%. But it also shows that the big slowdown has already taken place at the start of last year, and that since then, growth has been fairly stable. We expect that underlying economic growth in China will pick up, perhaps towards around 6%, which we think is a more sustainable rate. Now, we shouldn't lose sight of the fact that China's rapid pace of growth means that the economy is much larger now in absolute terms than it was several years ago. As such, China's contribution to global growth has barely changed over the last few years, even though it's been growing more slowly. As this chart shows, despite forecasts of slowing economic growth, in year-on-year terms, which is illustrated by the yellow line on the chart, the absolute size of China's annual expansion will remain close to that of recent years, as shown by the green bars. In other words, 6% growth now from a much larger base adds just as much to global economic activity as double-digit growth did 10 years ago. Or to put it another way, China was and still will be growing equivalent to adding the entire New Zealand economy to the country every 2 months. In a nutshell, we think current fears about Chinese demand and a hard landing are grossly overdone. In fact, viewed more positively, our own China activity proxy suggests that the bulk of the weakness in China's economy, which markets now fear, is actually already behind us. Turning to events closer to home, the Eurozone posted modest growth in the first half of this year, with recent data suggesting that this has continued into the third quarter. Moreover, with Greece's third bailout now in place, market concerns about Greece and a Grexit have unsurprisingly eased. It would, of course, therefore be quite easy to conclude that the Eurozone crisis is over and the idea of a Grexit is firmly behind us. However, we beg to differ. In fact, we think the crisis is far from over. Despite economic growth starting to recover, with high unemployment at around about 11% across the single currency area, weak wage growth, and inflation returning to negative territory, the Eurozone economy remains very fragile and is likely to need additional support from the European Central Bank in the form of additional quantitative easing. Furthermore, Greece's bailout could yet fall apart, and even if it does go the distance, the clear lesson from the last 5 years is that it won't address Greece's underlying economic and fiscal problems. Neither Greece's previous 2 bailouts, nor indeed the debt restructuring in 2012, fostered any meaningful recovery in economic growth or prevented Greece's debt to GDP ratio from soaring. It's worth bearing in mind that although the Greek economy has actually grown in 4 out of the last 6 quarters, the economy remains 25% smaller now than what it was prior to the crisis. And if things weren't bad enough, the Greek economy will continue to be squeezed hard by punishing tax and spending measures as required by the new bailout. While it's difficult to know what might be the final trigger, we think that a Grexit is still likely at some point. It's true that a Grexit now will be less damaging than it would have been a few years ago, but other peripheral economies remain fragile and face major challenges. Moreover, the biggest effect of a Greek exit on other peripheral countries may not be in the immediate aftermath of Greece leaving, but sometime later as a result of an increase in Greece's competitiveness via a devaluation of its new currency and the escape from excessive austerity. Indeed, if Greece were to thrive outside of the Eurozone, it could well prove to be a blueprint for other countries to follow, which could ultimately lead to a greater fragmentation of the currency union. And in addition, a possible exit by the UK from the European Union would also pose a risk to the outlook for the Eurozone. Now, looking to the other side of the Atlantic, with the strengthening US economy and falling unemployment, there has been much anticipation that the US Federal Reserve would raise interest rates this year. And as a result, the appreciation of the US dollar has been a headwind for commodities. However, the Fed again got cold feet in September and opted to leave interest rates unchanged, seemingly on the basis of a bit of a China wobble. Now, although some of the economic data coming out of the US has been mixed in recent times, there are 3 key reasons why we think that the economy isn't in any real difficulty, and that's why it shouldn't prevent the Fed from beginning to raise interest rates soon. First, if we take the US equivalent of the Purchasing Managers Index, here the US ISM activity survey, as the green line on this chart shows, the manufacturing sector has slowed down markedly in recent months, and that's being in part weighed down by the strength of the US dollar. But at the same time, output in the dominant services sector, which is the yellow line, has continued to hold up well and suggests that overall economic activity in the US remains robust. Second, the rate of unemployment in the US has continued to steadily fall. Furthermore, at just over 5%, the rate of unemployment is in line with the US Federal Reserve's own estimates of the long-term equilibrium rate. In other words, the US labour market is already close to full employment. And although there has been a slowdown in employment growth in the last couple of months, we do expect that this will pick up in the months ahead with the labour market fundamentals remaining strong. And third, although the headline rate of inflation remains undeniably weak, which is indicated here by the green line in the chart, and is only barely in positive territory, this is primarily due to the effect of the decline in oil prices last year. And in fact, if we strip out energy and food prices because of their volatile nature, core inflation, which is indicated here by the yellow line in this chart, and which is a better measure of the underlying inflationary pressures in the economy, it suggests that the US is far from having any issues with deflation. And so with the economy remaining strong, the labour market close to full employment, and core inflation nearly 2%, we think that the US economy is still doing fine. Thus, in our view, the decision by the Fed not to raise interest rates in September was a mistake. What's more, the Fed's hesitancy only seems to have reinforced investors' concerns about the health of the global economy rather than reassuring them. While much will depend on the incoming data over the next couple of months, we don't think that it's likely that the Fed will begin raising rates until early in 2016. However, with a tightening labour market, rising wages and price pressures, we think that that will mean that the Fed will have to continue raising rates through 2016 and 2017. And so while the delay in the Fed's decision to raise rates has taken some pressure off the US dollar, as the Fed gets closer to hitting the button, as I say, quite possibly early next year, commodity prices are likely to be hit by renewed dollar strength. Now, this chart just summarises our forecasts for interest rates for major economies. As you can see, in terms of the US, we are relatively hawkish, and although we do expect rates will remain quite low by historical standards. The Bank of England is also likely to start raising rates sometime next year, although at a much slower pace than in the US. In contrast, rates in Japan and the in the Eurozone are probably going to be on hold for the foreseeable future, and in fact, the ECB and the Bank of Japan are likely to continue to expand their asset purchases under quantitative easing. But what about emerging markets? Are they the third leg of the global financial crisis? Many commentators, including the Bank of England's chief economist, Andy Haldane, have suggested that the turmoil in emerging markets in recent months could be seen as the third leg of the global financial crisis, which started first in the Anglo-Saxon countries in 2008, and then brought the Eurozone close to break up for the first time in 2012. Specifically, Haldane argues that the loosening of monetary policy in the advanced economies since the financial crisis has driven capital into emerging markets and as a result has led to an unsustainable credit boom. And that this unsustainable credit boom is now turning to bust and has been compounded by falling commodity prices, the surge in the US dollar, and the prospect of Fed tightening. Now, we have a lot of sympathy with this view, but we will stress three more positive factors. First, as this chart shows, growth in emerging markets, as indicated by the green line, has slowed, and this slowing is not a new development. Indeed, much of the slowdown in emerging market growth took place between 2010 and 2012. And as I mentioned earlier, in terms of China, we expect its economic growth will start to recover over the coming quarters. Second, the recent weakness in local currencies against the dollar could also be part of the solution of the problems of many emerging markets. After all, it will help offset the impact of lower commodity prices, as well as boosting the export competitiveness of these economies. And third, the impact of lower commodity prices is quite uneven across emerging markets. There will, of course, be some losers, but many important emerging markets like China and India, for example, are large net consumers of commodities, which should benefit from lower commodity prices. Turning to commodities, at face value, the slump in commodity prices this year is consistent with a global recession as severe as that in 2009, as shown by this chart. This chart on the left-hand side shows the year-on-year change of one of the most closely watched commodity price indices, the S&P GSCI index, so the yellow line, plotted against world GDP growth, which is the green line on the right-hand side axis. Now, we do think that this does overstate the gloom for two reasons. First, rather than the slump in commodity prices being a warning sign of problems to come, it could actually be seen as a positive for the global economy, given the boost to economic growth that lower commodity prices will provide. In addition, it would also help to keep inflation low, which will help to keep interest rates lower for longer. Second, many commodity prices, including agricultural and industrial prices, have been trending down since 2011, as indicated by this chart between the green and the yellow lines. Of course, this does coincide with the slowdown in the Chinese economy since the global financial crisis. But what is interesting is that oil prices, represented on this chart by the energy index in the maroon line, was the main exception to this generalized weakness in recent years. Now, we suspect that oil prices have been propped up as a result of uncertainty created by the Arab Spring, which began in earnest in 2011, and that the crucial change now is that oil prices have simply caught up with falling commodity prices in industrial and agricultural markets, mainly as a result of the boom in the US shale industry and OPEC's decision to keep on pumping. Now, with many commodity prices priced in dollars, an appreciation of the greenback as a result of expectations that the Fed would begin to raise interest rates has also put downward pressure on commodity prices this year. And this is perhaps best illustrated by the inverse relationship between the trade-weighted US dollar index, which is the yellow line in this chart, and the S&P GSCI index, which is the green line. And just to recap, when commodities are priced in dollars, a stronger US currency increases the local currency cost in importing countries. Thus, all else being equal, dollar prices typically fall in order to maintain the same level of demand. However, arguably, what has been more important for a number of agricultural commodities this year has been the slump in currencies of several key exporting countries, as shown in this chart, which plots the changes in exchange rates against the US dollar. Now, true, part of the weakness in some of these currencies is simply a quid pro of a stronger US dollar. However, some big domestic and global macroeconomic factors have also underpinned or have also been important in these sharp declines in the value, particularly the sharp declines in the value of the Brazilian real, the Russian ruble, and the Ukrainian currency. But the key point here is that these large depreciations in currencies are actually creating a distortion for producers, such that producers in different countries are receiving the exact opposite message. Now, what do I mean by that? If we take soybeans, for example, this chart plots the price of soybeans in US dollars, which is the yellow line, and in Brazilian real terms, which is the green line. Prices have been indexed to 100 for the 1st of January 2014. But it's quite clear from this chart that the price of soybeans in both currencies fell sharply in 2014, suggesting that global supplies were more than adequate to cover demand. However, while the dollar price of soybeans has continued to fall, sending a signal to the market that production should be cut back, the fall in the value of the Brazilian real means that, in real terms, the price of soybeans has actually risen sharply. And that's sending a message to producers in Brazil that they should actually increase production. Not surprisingly, both the Brazilian crop supplier agency CONAB and the US Department of Agriculture are forecasting an increase in Brazilian soybean production this year to a record 100 million tonnes. A similar situation is occurring in the wheat market. As illustrated by this chart, the collapse of the Russian ruble has increased the price of wheat in ruble terms, while the US dollar price has continued to fall. And again, this suggests that while the global market is indicating that production should fall, from a Russian producer's perspective, they have been incentivized to increase output. Now, admittedly, falling currencies do not automatically make producers better off. While the weaker currency boosts producers' revenue in local currency terms, it also increases the costs of imported inputs such as fertilizer and pesticides. In addition, a number of these economies, particularly likes of Brazil, Russia, and Ukraine, are dealing with high levels of inflation, which means that domestic prices are also rising rapidly. However, as long as the fall in the value of the local currency offsets those rising costs, it makes sense for farmers to increase production in order to maximise revenue. Of course, weaker currencies also encourage producers to export as they receive more local currency for every tonne of crop that they export in dollar terms. And indeed, as Jack alluded to earlier, this has been one of the factors, or one of the reasons why the Russian authorities imposed an export tax on wheat exports earlier last year. And the underlying concern by Russian authorities is that the more wheat that was exported, the less domestic supplies that would be available, and that would increase domestic prices. At the same time, weaker currencies obviously increase the competitiveness of exporters, and these currencies can increase their market share by lowering the dollar cost or the dollar price of goods without undermining their own profitability in local currency terms. And indeed, the increasing competitiveness of European and Black Sea wheat has been a big factor which has undermined the US's ability to compete on the world wheat market in recent times. Now, this distortion comes at a time when bumper harvests, which was also mentioned earlier this morning, has allowed global grain and oilseed stocks to be replenished. As shown in this chart, 2015-16 world end-year inventories for wheat and soybeans are forecast by the USDA to be at a record level. And even for corn, inventory levels are expected to be well above the recent 10-year average. And also, as Jack mentioned, while total world consumption of grains and oilseeds has continued to rise, as a result of these harvests, this has led to an increase in the stocks-to-consumption ratios, which means that global markets are in a reasonably good position to withstand any supply disruptions. And so the upshot is that at a time when global supplies and key grain and oilseed markets are plentiful, falling prices should naturally induce a reduction in supply. However, large currency devaluations in key producing and exporting countries make it likely that this will encourage higher production. And with plentiful supplies, we think that this is likely to put further downward pressure on global prices. So to conclude, we think that the concerns of a slowdown in the Chinese economy are overblown and that it will not develop into a hard landing. Furthermore, the absolute size of China's annual growth will remain close to what it has been in recent years. The Eurozone economy is not out of the woods yet and remains fragile, but in contrast, a robust US economy should mean that the US Fed will begin to raise interest rates soon, and as a result, a stronger dollar will become a headwind for commodity prices. In addition, with the falling currencies in key producers likely to encourage additional production from producers there, we expect that with ample supplies, higher levels of production at a time when prices are already low will only add to the glut in world markets and put further downward pressure on world commodity prices in the short term. Now I'll stop there and happy to take any questions.
Thank you very much. We have time for a couple of questions. Have we got any questions for Hamish? I will just ask one question, Hamish. You mentioned the Brexit and the various issues that have surrounded the European economy. Do you think the EU's decision-making process and leadership is too slow to react to these situations?
It's certainly, given the size of the EU and the Eurozone, with the 17 countries in the Eurozone, 28 members of the EU, it certainly makes decision-making processes a lot less nimble than what they might otherwise be in a much smaller unit or as individual countries. And I think you do see across many different areas, often it does take a lot of time before you get a decision to make a change or implement a new policy because of the amount of time that is needed to negotiate with such a wide and very different countries and economies.